सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
India's merchandise trade deficit fell to a one-year low in January when the latest data came out. And on the other hand, the trade surplus that we have in services surged to a record high. What does this mean? Why did it happen? And why is our overall trade deficit shrinking? This is what we're going to discuss in this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and we have with us Radhika Pandey, Senior Fellow at NIPFB. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, as we usually do, let's start at the very basic. What are the current account and trade balance? What are these two metrics? Why are they important? Why should the government keep an eye on them?
Okay. So, current account and capital account, these are the two parts of a country's balance of payments. So, balance of payments is a account of the country's external transactions with the rest of the world. So, now how these external transactions are recorded? They are recorded either as part of the current account or as part of the capital account. Within current account, the most important part of current account is trade account, where we take into account the trade in goods. Where, as you rightly mentioned, we are having a deficit, but that deficit has narrowed. That means that we have a deficit because imports of goods are more than the exports of goods.
Right.
So that is one part of the current account, which is the goods trade. The other important part of current account is services trade, which we also call as invisibles. We have typically had a surplus in the services trade, meaning that our exports of services are more than imports. But during the last 2-3 months, we have seen a sharp surge in services export, and we'll talk about the reason. So that is another part of current account. And then there are some other parts of current account which include transfers. For example, if a person in India has invested in some shares abroad, the income on investment will be part of the current account.
I see.
So that the income, not the investment per se, but whatever intermediate income you are getting, that is part of the current account, and as well as some unilateral transfers abroad. So
Like remittances.
like remittances, those are all part of current account.
Okay.
Then we have the other part, which is capital account, which primarily includes foreign direct investment, foreign portfolio investments, and external commercial borrowings.
Right.
So that in sum total captures the total balance of payments of a country. And here we are focusing on the current account, which is mostly capturing the trade in goods and services.
Right. And now these are, of course, important metrics for a country to monitor the current account.
Yes, they are very important because if the current account deficit keeps on rising and it becomes unsustainable, then it will have a bearing on the external sector vulnerability. It will have a bearing on the currency. It will have a bearing on the currency's exchange rate. It will pose depreciation pressures on the rupee. So those are some of the implications, and that is why if we look at the economic survey, there is a chapter on current account where the chief economic advisor has argued for keeping a close watch on current account, because if the current account deficit becomes unsustainable, normally it's understood that if it goes beyond 3%, that is one threshold measure that till 3% is safe for a country like India.
Right.
We need to have imports, but if our deficit goes beyond say 3.5% of GDP, it tends to become unsustainable and will have a bearing on the exchange rate and lead to instability, lead to outflows, and have other cascading effects. So that is why current account deficit is important. And there's been a lot of discussion as of now. RBI governor has talked about whether current account is sustainable, manageable. So all these issues have cropped up because in the last 1 year we have seen that the deficit has risen because of increase in our imports.
Right.
And imports have risen because of increase in oil prices. We are one of the main importers of oil, and because of increase in oil prices, our imports have increased. Global commodity prices shot up, so that resulted in increase in imports. So that is the prime reason that there is a lot of discussion around the stability and what should be a manageable current account deficit for India.
Right, and now even in such a kind of uncertain global growth environment,
Yes.
having a high current account deficit also exposes us to these global risks as well,
Yes.
right?
Yes.
So yeah. So now you said that within the current account there is trade.
Yes.
And within trade, of course, there's exports and there's imports. Within exports and imports, we have merchandise and services.
Right.
So let's start first with merchandise.
Right.
What's been happening with merchandise trade over the last year and more recently as well?
Yeah, so as we just briefly mentioned, over the last, if we look at 2021-22, we had a good year as regards our exports are concerned.
Right.
We are talking about goods or merchandise exports. Merchandise exports touched USD $420 billion. So USD $420 billion.
In 21-22.
In 21-22, last financial year. And even during the first half of the current financial year, exports were doing fine. But since the second half, we are seeing that exports have moderated, primarily due to growth slowdown in US and EU. And if we look at the composition of our exports, we export gems and jewelry, we export textile, leather products. These are the things that we are exporting to countries like US and EU and European Union. And there, if there is a demand slowdown, so it will have a bearing on our exports. So exports have started to moderate, whereas imports have been rising, and this is the story till November 2022, December 2022, where we were seeing that imports were rising on a year-on-year basis. Imports were rising in double digits. Every month, imports were rising in double digits due to increase in global crude oil prices and global commodity prices. But what has happened over the last 2 months, and that is again in tandem with what's happening globally, that we've now started seeing that commodity prices have retreated from their peaks. So therefore, imports have also started to moderate. That is what we have seen in December and January. In January, imports have declined. It's not only that they have slowed down, but imports have declined. They have contracted by around 3.5% as compared to imports of January 2022. Even on a month-on-month basis, that is from December to January, there has been a sharp contraction in imports. And that is why, as you rightly started with the first line, that the trade deficit has become
it's been
12-month low, because our exports are low, but imports have also become low, has declined, and therefore the deficit between the difference between imports and exports has narrowed. So that is a positive development that has happened over the last 2 months.
Now, this is a positive development, but does it also, is it a symptom of even our own growth slowing, or is it only because global growth is slowing?
It's a combination. So if we look at imports particularly, what has slowed down, one of the main reason is that oil imports have remained strong.
Correct.
If we look at the composition of imports, where have we seen a contraction over the last 2 months? So gold imports have declined by 70%. So that is one of the main reasons. So, we have oil imports, and then we have gold imports, and then we have another broad category, which is non-oil, non-gold imports. So while oil imports have remained steady, gold imports have seen a very sharp contraction because of measures taken by the government to discourage non-essential imports. So therefore, gold imports, particularly in January, which is the latest data available, there we saw a contraction of 70%. Even the non-oil, non-gold imports have slowed down, which is a reflection of decline in global commodity prices. Whether
I
it's
see.
a reflection also of a slowdown in domestic demand, that will be seen over the next couple of months. If we see that this import slowdown is sustained, even during a time when global commodity prices start seeing an increase, then we can be more confident in saying that it's weakening demand is also one of the symptoms. But as of now, it's mainly an indication that global commodity prices have retreated from their peaks, and therefore goods imports have slowed down in the last 2 months.
Basically, the import bill has come down because prices are lower.
Yes.
Right. Okay. And so now then coming to services,
yes.
which is the surprising thing, which is the unusual thing that's been
Yes.
happening. What has been happening with services?
So services, if we look at over the last few months, we are seeing that services exports have been rising at a sharp pace, and particularly in December of 2022, services exports increased by $4 billion in 1 month.
Wow.
So that was a very eye-catching development, that services exports over November to December, there was an increase of $4 billion. And now if we look at the numbers, it's interesting to see that exports of goods and exports of services, the number is exactly same. Both are USD $32 billion. So because exports of goods has moderated and exports of services has seen a sharp rise, so now it's both of them in January, the numbers were they were similar. Both were USD $32 billion because on average, every month exports of services used to be around $23 to $25 billion. But over the last 2 months, exports of services have increased. And if we delve deeper into the key drivers, what has led to this increase in services exports, for that we look into the balance of payments data. Okay? Because monthly data does not tell us about the key constituents of exports. It only tells you the aggregate number. To delve deeper into the constituents, we look at the balance of payments number, which comes at a quarterly frequency and with a lag. It comes with a big lag. For example, as of now, we have the balance of payments data till September quarter.
Oh, wow.
So we don't, the December quarter data will come at the end of the next quarter. That is on 31st March. We will have the balance of payments data, like the entire current account, capital account. For the December quarter, we will have on 31st of March. So it is useful to look at the balance of payments, look at the net inflows on the services account for the April to June quarter and the July to September quarter, and compare it with the April to June and September quarter of the last year. First half of this year and first half of last year. And there we see that there are 3 services which have seen an increase. One is, of course, the telecommunication, information and communication services, the ICT. The other is financial services. But the most noteworthy development is in other business services, which is normally a very small constituent of our entire services export basket. But over the last 2 years, after the onset of COVID and then supply side disruption, we have seen that business services, basically things like research and development, outsourcing of audit-based services, accountancy, legal services. These are all part of what is the broader category, which is called the business services.
This could be driven by cost cutting.
Yes, this is driven by cost cutting because if we look at countries like US and EU, they are facing high inflation, and within inflation also, goods inflation has started to come down, but services inflation is still red hot. And even the Fed chair made this remark that now they will have a granular look at the services inflation because they have won the battle on goods inflation. They would now like to shift their attention to services inflation. So given that services is still very costly, companies are looking to do cost cutting by outsourcing services to low cost highly skilled economies like India. And there we see that we have gained an upper hand in this because of this outsourcing favorable destination for outsourcing. No language barrier, we understand English. Time zone variation is very favorable because there when it is night, here we have day, so we are able to complete the work and give. So there, all these things have really helped in increasing our business services exports. So those are the three drivers. On the other hand, travel, tourism, which used to be very prominent parts of our services export basket, have seen a contraction.
Which means there are fewer people coming to India
Yes.
for tourism.
Yes, so there is a compositional shift in the services export basket over the last 2 years, and particularly after the high inflation phase that we've seen in developed economies, and therefore we are seeing a big increase in services exports.
Right. And now coming to a question from the audience regarding services, looking at the economic outlook for the upcoming year, how do you see the position of trade of services? Do you think it will continue to have a positive outlook?
So long as there is going to be inflation problem, which is quite evident from the Federal Reserve minutes. Last night only the Federal Reserve minutes came out, and there they have again flagged concerns around inflation. They have flagged concerns around services inflation. They have flagged concerns around that they are going to raise interest rates. So long as that inflation remains elevated, we should expect this increase in business services exports to continue and to remain sustainable. On the other hand, we are also seeing some other new items. For example, defense exports, green hydrogen exports. So once these exports also pick up, then we should see a major change in the composition of our export basket, because we have already committed that from FY 25-26, we will start exporting green hydrogen. So,
but that will come under merchandise.
That will come under merchandise, but I'm just talking in terms of the entire trade deficit that will have a bearing.
Right. And now this is an interesting question from the audience. When do you see us with a consistent trade surplus? Although a subjective question, what could be the key drivers to turn around the equation and thus permanently do away with the twin deficit problem? And just for context, the twin deficit problem is basically having a fiscal deficit and also having a current account deficit that are both high. So, the fiscal deficit, I don't see us getting out of a fiscal deficit anytime soon, because we're always going to be spending more than we're earning, because that, for a developing country, that's the only way forward. For a trade deficit or a trade surplus, I'll let Radhika take that up.
Yes, so there also, like we talked about, there are a number of strategies, policy priorities that the government is doing and should continue. One is capitalizing on the China Plus One strategy. How the firms that have left China, whether they are setting up bases here, that is one thing. The other is how we are going to capitalize on our free trade agreements that we are doing with a number of countries.
Yes.
For example, with UAE, we have done a comprehensive economic agreement partnership, and there we have benefited from agreement with UAE, especially in terms of exports of gems and jewelry and other labor-intensive commodities.
It was a recent agreement. We're already seeing benefits of.
Yes, because we have this monthly data, and so there was a press release in November which said that since the signing of the CEPA, we have seen increase in exports to UAE, which is more than our exports to the global economy. So we are exporting more in terms of the rate of growth. The rate of growth to global economy is lower, and the rate of growth of exports to UAE is high. So it is being attributed to the CEPA. So one is how we are diversifying our export basket, given that US and EU are facing a slowdown, and US and EU are our major trading partners. If we look at the composition, almost 46% of our textile exports goes to US. So if there is a slowdown there, that will have a bearing. So if we want to move towards a surplus, we cannot have a surplus, but we want to moderate our deficit, we need to diversify our export destination. We need to capitalize on the FTAs. We need to think of more export items like defense exports. Also, we have seen a pickup. Government is setting up new targets. For example, for this current year, the export target for defense is 17,000 crores. So if we capitalize on all these developments, we will move to a situation where trade deficit will definitely narrow. But there are some items for which we are dependent. For example, oil imports is not going away anytime soon, and we are one of the major importers. Edible oils, we are importing edible oils. So what we can do is we can work on our export basket to see that we are able to moderate the trade deficit.
Right, and actually, you mentioned oil. There was recent news that in I think Jammu and Kashmir they found huge reserves of lithium.
Yes.
And now lithium is used in battery technology, and now as everybody is trying to move towards battery-operated, battery-powered technology, electric vehicles, and all of that. That could, if these reserves prove to be actually viable, that could prove to be a big source of exports for us as well.
Yes, that the semiconductors plants have been set up there. So it will take some time, but we should see a compositional shift in our export basket in the coming few years.
Right. And you also you spoke at length about the FTAs, and I mentioned that because there was a question from the audience on that, which is how much contribution do you think the free trade agreement had in this reducing of the trade deficit? Which he's talking about the UAE, Australia, and we're planning to do one with the UK. It's in the works, and maybe one with the US. Yeah. But you've already explained that.
So we need to be careful in what are the agreements. But if there is a greater market access, then definitely we stand to benefit from these FTAs, and we are able to diversify our export destinations.
Right. And now another question we have is the trade deficit decrease dependent on Russian trade? Previously, we were trying to trade in rupees. Did we change that, which led to the reduction in the trade deficits, or is it that exports have increased? Now, our exports have not increased. Yeah. So
Russian trade definitely has played some role because we are getting discounted oil, but it's not that we are. It's a small discount. So in the absence of this, maybe our trade deficit would have been even wider. It has definitely helped in a moderate way to cushion our trade deficit. Right. But that is not the only reason for bridging of our trade deficit that we have seen over the last 2 months. As we've talked about, our imports have come down. It's not that our exports have risen. Yeah. Our imports have come down, and that is due to a 70% decline in gold imports and decline in commodity prices, reflecting in our import bill of non-oil, non-gold imports. So while discounted oil from Russia has played a role, but it's not such an important driver because the decline in trade deficit that we have seen is only over the last 2 months. And that is mainly a reflection of the decline in commodity prices.
Right. And when we talk about trade and India, it's impossible to not mention China. So now this is again a question from the audience. And do you still think the biggest challenge for India is with regard to its rising trade deficit with China?
We have the annual data for the last financial year, FY22. Our trade with China surged in 21-22 and it rose to more than $100 billion. And the deficit with China within that rose to more than $70 billion over this is last year. And we are importing a lot of items from China, ranging from capital goods to industrial raw materials to pharmaceutical raw materials. So it's not very easy to do away with the dependence on China. To some extent we can do, but it also depends again on our priority for each sector, how we are going to handle and reduce our dependence, because we are exporters of pharmaceuticals also, but the ingredients we are importing from China. A lot of raw materials, industrial raw materials we are importing, and then we are making it into final finished goods. So we need cheaper raw materials. So that is a policy priority as to how much dependence we need to reduce on China. And again, this is something which is not going to happen in the next 1 or 2 years. It's again a medium-term strategy that needs to be adopted over the course of years.
Right. So there you have it. Our merchandise trade, our exports have been shrinking because the global economy is kind of slowing down. They're spending less. They're buying less from India. Our imports from the world, the import bill has come down for various factors. One is that our gold imports have come down because of government actions regarding tariffs. And on the other hand, prices have actually eased quite a lot. So our import bill is a lot less than it was. On the services side, our services exports have surged big time, but that's because in the West, they're doing a lot of cost cutting. Inflation is hitting them hard. And so they're turning to countries like India, which provide high quality services at very competitive rates. This is likely to continue for a little while because inflation in the West is also likely to continue for a while. So that's good news for us. And so overall, all of these things together are leading to our trade deficit shrinking. And that's good news for India because it makes us somewhat more secure in a globally uncertain time. That's all from us. Thank you so much for watching.